Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Namaskar, my name is Shishir. All the high-frequency economic indicators are showing very good sign. Talk about the GDP number, talk about the GST number, talk about the fiscal deficit number. They all are saying very good sign, and it seems that the economy is progressing well. To talk about more, we have with us Chief Economist of ICRA, Aditi Nayar. Aditi, welcome to the show.
Thank you, Shishir.
Aditi, the first question is about the GDP number, 7.8% for the April-June quarter. Which is the most important factor in this? What are the things which push this number from 6.1% in Q4 to 7.8% in Q1 of FY24?
So, Shishir, these are very interesting quarters because if you look at Q1 of FY23, which is a base for the quarter that we're talking about, that is when India was just coming out of the lockdown and we were getting back to work and getting back to school. And so it was still a quarter where the base was low, but it was recovering. I'm not sure that it's a very good thing to do to compare the YOY growth in Q4 of FY23 with the YOY growth in Q1 of FY24. So let's not make that sequential comparison because I think that's going to just not be terribly meaningful. Instead of that, let's look at the YOY growth in Q1 FY24 by itself, which is a growth of 7.8%. And I must say our forecast was higher. For GDP, we had factored in 8.5%. And for the GVA, we were looking at a growth of 8.1%. So firstly, the numbers have come in a little bit below what we were estimating for this quarter. And the main reason for that is that we expected the manufacturing sector to show a much higher GVA growth than what the NSO has put in its first estimate, which came out yesterday. The reason we expected manufacturing growth to do better was because margins for the corporate sector have seen a lot of relief from commodity prices coming down from the peaks that they were at in Q1 of last year after the Russia-Ukraine conflict had escalated. And we thought that improvement in margins would translate into a better GVA growth. What possibly has happened is that for the unorganized sector, the first round of data actually uses the IIP, which is a volume indicator, as a proxy. And while the IIP growth has shown an improvement, but obviously volume growth has been lower than where the margin growth has been. So perhaps this is one of the reasons that the proxy is not being very useful in the current context. It's possible that we may end up with the manufacturing number getting revised higher, which could bring the GDP and the GVA growth closer to our forecast for Q1 FY24.
I compared the sequential number because many of the time what happens that sometimes you have a good number in terms of sequential, sometimes you have a good number on Y basis. So that's why I just gave that picture. I understand that 13.1% in Q1 of FY23 was mainly a base impact, a base effect. So that was the reason. Now the other thing is that should we say
we are arguing that both things, both looking at the growth in Q1 FY23 and then saying it's a slowdown in growth in Q1 FY24, that is also misleading. And also looking at the sequential movement and the growth levels between Q4 of FY23 and Q1 of FY24 are misleading. So it's a very peculiar situation for this quarter.
I agree. Is it correct to say that this current growth number, I mean the first quarter growth number, is mainly the consumption driven?
So interestingly, we have a 6% growth in the private consumption. We have a higher 8% growth in the investment activity. And we have a completely flat number of minus 0.1% on the government consumption. So very mixed underlying trends. A lot of the high frequency indicators for investment activity had actually suggested to us that the investment growth or the gross fixed capital formation growth could be even higher. So this, on the expenditure side, this came in a little lower than what we were hoping for. But I would say that a 6% growth in private consumption, given the inflationary environment, it's pretty good. So I would say that I'm quite happy with where that number has come in.
And one thing, is it correct to say that the private capex has picked up now?
So I would say it's in the process of picking up. The sort of environment for a private capex, sustained upturn, I think we have the building blocks for that. Capacity utilization is around that 75% mark, that magic 75% mark, after which the private sector typically starts to invest in capacity addition. Last year, we saw very high project announcements by the private sector, and we don't expect it to all fructify very quickly, but we are seeing meaningful intent to invest in a number of sectors. And I think that going ahead, we should see steady private sector capex, and hopefully it will broaden as well.
Okay, now almost we are 5 months away from the general, 5-6 months away from the general election. Do you see that the government expenditure, especially in terms of revenue expenditure, will go up?
Look at the breakup of the fiscal numbers. It's actually been very interesting. Capex growth has been very high in the first few months. And revenue expenditure growth was actually very low in Q1. And then suddenly in the month of July, we've seen a big step up in the revenue expenditure. And going ahead, kind of what we're reading is, or what our assessment, or what we're understanding from the numbers is that perhaps the government is very keen to front load capex to make sure that if, for instance, there is the model code of conduct being in place in Q4, which is typically something that would slow down capex, we don't end up with the budget estimate for capex being undershot by a wide margin. So we feel like there is a concerted effort to front load capex. Central tax devolution to the state governments has also been front loaded. The capex loan scheme also has seen faster approvals as compared to last year. So all of these things together suggest to us that the government is possibly very consciously trying to front load capex to ensure that the budgeted target is not missed.
Coming to the two high frequency indicators, one is the core and the other one is the purchasing manager index for manufacturing sector. So core is 8.2% as against 4.7% last year. And if we take the sequential number, it is 8.2% in June and 8% in July, and 4.7% last year. So how do you read this number, since it's a 40% of total industrial production weightage, which the number we will get on 12th of this month?
So I certainly think the core sector number is quite robust. Even the underlying trends did seem to be quite healthy. One specific factor, because we've had very poor monsoon in August, actually electricity generation has jumped a lot in that month. So that is again something that will push up the core sector number for August, along with the overall IIP number as well. And there obviously we don't like to see an erratic monsoon. We don't like to see a subpar monsoon. But sometimes it does come with a silver lining that when you have more of an extended dry spell, then construction activity can actually take place. So maybe there will be some silver lining to this terrible monsoon that we've seen in August.
And what about the PMI latest number?
So PMI numbers typically, it's an interesting index. So it's not necessarily something that correlates very well with the kind of GDP numbers that we get going ahead. So we prefer to look at the other sort of high frequencies, which are more volume based, rather than looking at the PMI, which tends to be more of a sentiment indicator.
Okay. Now coming to GST number, it is in the range of 150 to 160 lakh crore. And now almost 150 has become 1.50 has become a new normal kind of thing for GST. How do you read this number?
This is broadly in line with what we were expecting, that the GST growth would start tapering off because of the base effect normalizing, but the absolute numbers would remain healthy. And our earlier estimate was that GST would be around 1.6 to 1.62 trillion in the month of August, and that's very similar to the number that you're mentioning right now. So I would say that GST collections are largely looking like they're going to be on track, and that is going to be quite supportive for the fisc.
Okay, now coming to the last part of our discussion, that is the inflation, which is at this moment seems to be the biggest worry, not just for the manufacturing sector, but also for the overall economy. How do you see that?
Lots of moving parts as far as the inflation number is concerned. We've hopefully seen the worst of the tomato price panic, but other vegetables, pulses, other items now seem to be becoming a little bit more of a concern. And again, going back to the monsoon, it's been a really uneven monsoon. And now, even if we end up with the rainfall in September being at the top end of the range that the IMD had given us on the 31st, even that would mean that the full monsoon season is going to get characterized as below normal. So this really hasn't been a very good monsoon. Also, we don't like to see very heavy rainfall in the month of September because it can have an impact on the standing crop. Delayed withdrawal of the monsoon can also then start affecting the harvest. But we do need the rainfall to still be good enough to support the reservoir and the groundwater levels. So it's a bit of a catch-22 situation.
And what is your assessment for the August inflation number, which will be out on 12th of this month?
So we expect a modest fallback in the August inflation print, and then we expect a material reduction in the September inflation print. So September is when we think things are going to look a lot more comfortable. And by the time the MPC meets next, the technical 4-month monsoon season will be over. The sowing numbers will be before us. Also crop-wise, even though we do think that the overall sowing may be at par with last year's, but clearly it's going to be very difficult for pulses to pick up pace in the last month and come close to last year's sowing area. So I think the MPC will have a better understanding of the crop-wise inflation pressures when they meet next.
And August number, can we say something around 6.8, 7.2 or 7% or more than 7.4%?
So we are still fine-tuning our August number. Since yesterday, we were very caught up with the GDP numbers which came in. I would say that, we've seen a lot of moderation in tomato prices, specifically in the second half of August. As of now, I would say that we are going to be, let me put it this way, 7% plus minus 0.2% is probably where we're going to end up. But yes, we have to still fine-tune this number.
Okay, now a final question to you. Since everybody is talking about the GDP number for the whole year, government is very bullish, but there are some sort of apprehensions among economists like you. Are you going to revise the number, what you said earlier, or do you stick to the same GDP still?
So my earlier GDP forecast was already quite, I thought realistic at about 6%. And as of now, we are not revising it either up or down, even though the Q1 print has come in a little bit lower than what we were penciling in. For now, we're going to stick with our 6% GDP forecast for the full year.
Aditi, thank you very much for joining this show.
Thank you, Shishir.